Jerome Powell is expected to announce another Fed rate cut this coming week in December 18th. This is obviously going to make the market move, but there's many other things that we need to be discussing, and so we're going to talk about that in this video. Things like, will home prices fall? Will the mortgage rate be brought down? And if so, how much? And just my overall state of the economy and how you should invest over this next year based on what we're about to see in the coming weeks. With the rates going lower, lower borrowing costs make it easier for companies to finance projects and for consumers to afford purchases. Capital-intensive industries such as in technology and utilities often perform well after rate cuts. Sub-industries within the financial sector, such as asset management and insurance, are likely to outperform. Lower rates make borrowing cheaper, driving growth in sectors including real estate, utilities, and financials. These are the top 7 types of stocks that do well in a lower rate environment. Real estate stocks, home builder stocks, utility, technology, financial, insurance, and consumer discretionary stocks. My name is Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. A premature rate cut risks derailing months of progress and reducing inflation, but rates staying too high for too long could damage the labor market and economic growth. I'd love to hear from you. Do you think these rate cuts are going to help us or hurt us long term? Also, what are you planning to invest in 2025? Comment down below. Consumer prices rose 0.3% in November and 2.7% over the past 12 months, according to new Consumer Price Index data released Wednesday. The monthly inflation rate and annual inflation rate each rose by 0.1 percentage points from their October levels, in line with consensus estimates from economists. So since these numbers are in line with what was hoped for and what was expected, it's still expected that the Fed's going to actually cut rates next week. But this does not mean that that's the right move. As stated before, cutting rates too soon can lead to massive inflation, rising very quickly and putting us right back where we were and starting this whole process all over again. Many point to the new administration taking office this coming year, namely President Trump. While he has some favorable ideas for the country and for business overall, some of his ideas and plans could really hurt the country. A broad consensus of economists agree that tariffs, mass deportations, and tax cuts will likely increase costs on average consumers. Knowing this may be coming is very important for you to keep in mind. You need to be investing for the future and not just for what's happening right now in real time. Long-term, inflation is going to hit again. This could be in 1 year, this could be in 5 years, this could be even further. Either way, you need to be stacking those appreciating assets to help beat inflation. That's the core reason why we invest, to make our money work harder than we can and to keep up with, but hopefully beat inflation. As far as this supposed rate cut next week, Morningstar chief U.S. economist Preston Caldwell says the outlook is less certain. Markets still seem to be pricing in an overwhelming probability of a cut, but we see the outcome as more of a coin flip. This chart shows that many believe the rate will be cut down to the 4.25 to 4.5% rate rather than stay at this current 4.5 to 4.75% rate. So basically what this is saying is that you need to be very careful investing right now. Just about every time that the rate has been cut, the market reacts favorably and the market's jumped. But it jumped early and then leveled out, and then there was a little bit of a dip that followed that. So going in and investing much more than normal right now, just because you think that there's going to be this spike that comes, may not be the best move. At the best, you're going to gain a little bit on your investment in the short term, but then it's going to kind of level out and probably come back to right where you've been investing at. At the worst, and basically what that chief economist just said, is that the prices might already be priced into the market, and so they've already figured out that it's going to jump or how far it's going to jump, and maybe this is the possible top. Other investments need to be kept in mind as well, namely real estate. A lot of you are holding off for lower prices or at the very least, lower mortgage rates. Industry forecasts that home prices are entering a period of sustained deceleration could help more home buyers qualify for mortgages, but not if rising consumer prices drive up 10-year treasury yields, and consequently mortgage rates, which closely track that benchmark. Assuming a more gradual pace of rate cuts in 2025, mortgage rates are generally expected to follow a similar path, likely settling in the mid to low 6% range by year end. The young families expected to drive home sales and price gains in 2025 have maintained their optimism, reports Fannie Mae, that mortgage rates will fall despite industry consensus that average 30-year fixed mortgage rates are unlikely to drop below 6% before 2026. This is very important to keep in mind. Many believe that these rate cuts that are currently happening and that are going to continue happening in 2025 are going to substantially bring the rates down, specifically in the mortgage rates, but it looks like we're going to be seeing higher rates for longer. Hoping for that 3% mortgage rate like we saw a couple years ago probably isn't going to be a thing for a little while. When figuring out what you and your family should do as far as buying a house or in buying a rental property, make sure to calculate all the expenses, especially opportunity costs, because it may not make that much sense for you to rush into buying a home or buying a rental property at this point. There may be better places for you to park your money. It may even be better for you to continue renting at lower rates, be able to use that extra amount that you're saving, not having to pay for those high mortgage rates at this point, and use that to invest in something like the S&P 500 or the 3-fund portfolio that I talk about. I'm a real estate investor and I like rental properties, but I'm definitely not going to be rushing it. Overall, what I am bullish on is the stock market in general. But I do believe that it's going to be quite volatile. I do think there's going to be weeks of heavy negative followed by weeks of heavy positive. Investor Business Daily analysts say that Moderna, Biogen, and Micron Technology are seen jumping more than 43% in the next 12 months. That's the highest gain expected from any S&P 500 stocks. Analysts are already very positive for 2025. S&P 500 stocks on average are seen gaining more than 9% in 12 months. I would agree with a lot of this. While I'm not as big of an individual stock investor, I do own a couple of them, and those couple ones that I'm very, very bullish on, I am going to continue to invest in very heavily during 2025. Overwhelmingly though, I am in broad-based market large cap ETFs, which make up my 3-fund portfolio, and I'm just going to continue dollar cost averaging every single month no matter what happens in 2025. I'd love to hear what you're invested in now and what you plan to invest in 2025. Please comment down below and then watch either of these 2 videos to keep you going strong in investing, and make sure to keep investing simplified.